So 2021, entertainment is still not deductible. Going in from 2020 to 2021, meals are now 100% deductible. Last year, they were only 50% if they're purchased from a restaurant.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This week I'm joined again by last week's guest, Laura Caiafa. Laura is a tax preparer and enrolled agent with Caiafa and Company, located in Hamden, Connecticut. Thanks for coming back on, Laura.
Thanks, Ryan.
And last week we talked about tax tips for people going into their first year of retirement. But this week I'd like to talk about tax tips for people who are still working, and specifically those people who are running small businesses. And you mentioned last week that you work with small business owners. And I know we had talked a little bit about some tax tips you had specifically for them that we wanted to address this week. I think you'd come up with 5 tips that we're going to cover today. So tell me a little bit about, maybe you could start with like the first tip that you would have for someone running a small business to try to save some money in taxes.
Yeah. So first off, what I would say, just getting started, to make sure when they're tracking their income and expenses that they're using some sort of software to do so. We recommend and we use QuickBooks. So you can use similar software, but the key is having an actual accounting system instead of going off of a shoebox of receipts method, or even worse, I've had clients go from memory.
That doesn't work?
That does not work. So I'd say, you're getting started. You want to get up and running with an organized set of books. It keeps stress levels down for both the business owner and the accountant. So, and the big thing there is you want to avoid mixing personal and business expenses as much as possible. There are some personal expenses that could be considered business deductions, but typically we allocate a portion of those. So for instance, your cell phone. So If you're using your cell phone and you're getting business calls, that's fine. We can allocate a portion of that as a business expense. But in reality, the IRS knows, if that's your personal cell phone, it's not 100% business, right? So there's expenses like that you can track as well. And we'll just take an allocation. It'll get deducted, but it'll just be an allocation. Another thing that you want to do off the bat too is if you use your car for business, you'll want to track your miles. Sure. I just want to note that commuting is not allowed. So if you have an office and you're going from your house to your office every morning, those are commuting miles. Those are not deductible. Okay. So it's if you're going to see a client in New York or wherever, track the miles. Those are legitimate business miles that you'll want to track to and from your house.
I think there's an app for that too, right? Isn't there?
Oh,
there's probably many apps, but
Yep, there's many apps. So definitely you could check out App Store, Android. There's definitely something to assist you in that. Other expenses that you'll want to track as well is, home office type deductions. Those would be available to clients as well.
Is that, I know last year, maybe even into this year, well, I would say in 2020, a lot of people were working from home due to COVID, maybe a little bit less in 2021. So what qualifies you for that? Like, let's say prior to 2020, you didn't work at home ever. And now all of a sudden you worked at home in 2020 and even into 2021.
Yeah. So just to be clear, set the stage here. If you're an employee working from home, you don't get any deduction. It does not matter. Okay. But we're going off the premise here that you are a business owner. And now, you can't go to your office or you don't see clients anymore because you're working at your home. So what you really need to do is make sure that your home office is not being defined as the dining room table. So that is key here. You need to have
buy a folding table.
You need to have a defined area of your residence. And the key word here is exclusively used on a regular basis for business purposes. Okay. So, you use a bedroom or part of a bedroom, the actual square footage, you don't use it to iron. It's just for business purposes only. So those are critical things. And the reason I say that is, it's one of the areas that the IRS really scrutinizes. So you want to make sure that, you have your ducks in a row. You can say, yep, this is the square footage I use. You have 2 methods. You could take the simplified method as a deduction, which is really just the square footage.
So if you have the bedroom's 200 square feet, you get to deduct that percentage of your household expenses that equal that or something?
Right. Your total square footage. So we would ask you for your square footage of your
actual office. If it's 2,000 square feet, let's say, to make it easy, right?
Yep.
200 is the bedroom. That's 10% of your house.
Correct. Yep.
Okay.
So then you get a simplified deduction just based off of the square footage.
So your utilities, if you paid $2,000 for electric and $3,000 for heating oil, you get to deduct 10% of that?
So there's the simplified, which is square footage only. Then there's the actual expenses, or they call it the regular method. That's where you can take typically a higher deduction. So now you get the square footage. Now you get to allocate, like you were saying, the utilities, your Comcast, or your taxes, your home insurance, your mortgage interest. So you can it's a larger deduction typically. You also can depreciate your home. Down the road, there could be repercussions in doing that, like depreciation recapture when you sell your home. That gets into a whole nother topic. But basically, you use your simplified method if you want to be a little bit more conservative and you want some deduction, but you want less eyes on you. You would go with the simplified method. Its name is the simple approach.
Keep it simple.
Keep it simple. Yep. But, there are clients that would, I have contractors who might be using an entire area of their home for keeping their supplies. So it all depends again on the client, but it's really making sure that area of your home is exclusively and regularly used for business purposes in order to take that deduction.
Okay. So I think we had talked about second thing was that possibly being able to deduct meal expenses in 2021 and 2022. That was like a change that happened, right?
Yeah, there was they kind of revamped the whole meals and entertainment deduction. A couple of years ago, they completely got rid of the entertainment portion. So you can no longer take your buddies or prospective client to a Yankee game and, deduct the tickets and the beer and the cheeseburgers. They got rid of that whole thing. And that still stands for 2021, but it's an ever-changing kind of bucket. So 2021, entertainment is still not deductible. Going in from 2020 to 2021, meals are now 100% deductible. Last year, they were only 50% if they're purchased from a restaurant. So basically what they're trying to do is favor restaurants that have been hurt the last couple of years due to COVID. So they're trying to bring people back into the actual restaurants. There are other meal types that get complicated. So I'd say, check with your accountant on specifics because certain meals are still 50% deductible, like things from grocery stores.
But office party and you go buy all the stuff at the grocery store, you can't deduct 100% of that.
Now this is why there's complicated because that's a whole nother bucket. So if you actually have what you're kind of explaining here, a company holiday party or social event, actually those expenses are 100% deductible.
Okay.
So as I was mentioning another time that we spoke, that there's charts of all different types of meals.
Yes, you said that.
Yeah, it gets a little nutty. So definitely check and make sure you do your due diligence because some are 50%, some are 100%, some are not deductible at all. If you put out snacks for employees, it's 50% deductible. So it just gets a little funky with all the different rules.
Sure. But the entertainment part is still not deductible.
Still not deductible.
You really want to make sure that if you do take clients to a sporting event, that you get an itemized receipt, I guess, so that you know how much was for the tickets versus the food costs.
Well, honestly, I would just completely consider that whole thing not deductible just because you're taking out the entertainment part. The IRS would argue, well, you didn't need to go there to talk business. You could have had the client come to your office and sit with you and chat. So that's where it gets a little dicey. So I would, any sporting event, any entertainment type stuff, I would just consider the whole day or the whole timing just not deductible for that day. And what we recommend to clients actually is on their books, what we do is we actually break out meals and entertainment and we have a subcategory entertainment. You can drop expenses in there. Just when we do your taxes, that bucket becomes not deductible.
Okay, that makes sense. Mm-hmm. What was your third tip?
So, we were talking about deductions and things for small businesses, and we're big proponents of health savings accounts. So if you're self-employed and, you want to take advantage of having a health savings account, you just need to make sure that you're in a high deductible HSA qualified plan.
Sure.
And we recommend you max out that HSA every year. A lot of people might know that you get the deduction for the money going in, a pre-tax deduction. And then when you take the money out, as long as it's used for qualified medical expenses, it's non-taxable. And that's great. But the tip here, I would say, is put the money in, but don't take the money out if you can help it. Sometimes easier said than done. But, if you have a copay you have to go buy medication and it's $50 and you can afford that out of pocket, just pay it out of pocket and leave that health savings account growing tax-free over the years. What you can do is come retirement, your income might be down. So it might not be as easy to just take money out of pocket to pay your medical expenses.
Yeah.
But what you can do is you can reimburse yourself from years prior. So if I have a medical expense now of $1,000, I pay it out of pocket, keep the receipt or scan it electronically. 20 years down the road, I can reimburse myself for that expense. So essentially, you'll have another large bucket of tax-free money, kind of similar to a Roth IRA, that you can take out down the road, reimburse yourself. And, when your income's lower where you can't just pay out of pocket, you have the money available.
Yeah, I love that. I'm a big fan of health savings accounts. I've covered the topic on a few episodes. Yep. And yeah, I mean, it's even better than a Roth because you're getting a deduction up front, whereas a Roth, you don't get a deduction. And then, I usually recommend that people invest the money because if it's going to sit in there for 10, 20 years, rather than earning 0% interest, which you're earning now, many of these plans allow you to invest the money in a stock fund or stock and bond allocation. And if they don't, you can always transfer it over to another company that would. Sure. Like I use Fidelity. I recommend people use that or a comparable one so they can invest it. Do you suggest that with that people maybe maintain like an Excel document or something just to like input the expenses as they come so they have some idea of like what they potentially could take out at any point?
Yeah, and Excel is great. Nowadays, there's also apps for many things. You can snap a photo of the receipt and, I believe you could kind of likely act as an Excel file and in the background track the money spent. So, there's a lot of apps. I can't think of one off the top of my head, but, snap the receipt on your phone and you could chuck the receipt so you don't have to keep paper for all these years.
True.
But then you'll have this saved electronically. But, an Excel file is great as well.
So have you ever had a client who's been audited by the IRS for health savings account abuse?
I actually have not. No.
Okay. Yeah, I think what you're saying is absolutely the right way to do it. Cover yourself. The odds are probably low that I would guess you're going to get audited, but you want to have the record so that if you do.
Yeah. And you know what, Ryan, too, a lot of these. So if somebody has, an account at Walgreens or CVS or one of these other pharmacies, they can pull records. So, they could go back, I don't know how many years, but they can see how much you've spent there. Doctor's offices, if you go to one main doctor.
That's true. Yeah.
God forbid you had a major issue and you were spending, big dollars. You could always go back and kind of retrace your steps and prove that you had these expenses.
Yeah. And it's probably something that maybe will come up more because the health savings account, I don't know how old it is. Is it like 10 years old?
Yeah, I think roughly. I'm not too sure, but
I don't know either. But I've started like early, years ago, I would see minimal balances, if anything, in these accounts. Now I'm starting to see people with $60,000, $70,000 in a health savings account. And so now it could be a considerable account where the income really matters to make sure that it's not going to be taxable to you if it really does qualify for not being taxable.
Absolutely.
Yeah. We had talked a little bit about tip number 4. This was one that I was not aware of that people could qualify for. Tell me a little bit more about that.
Just the rental.
Yeah, the rental. I mean, tax-free rental income, right? Sounds too good to be true.
Yeah. So, I mean, the general rule is, if you rent your residence or other residence or vacation home for 14 days or less, you don't pay income on that. You don't pay tax on that income. So it's a nice way to pick up a little bit of money without paying tax. The way I've had clients kind of use this rule to their advantage in the past is either a vacation home, when they're not using it, they might rent it a couple weeks out of the year. Or another big thing people do is if you live near a college or maybe some popular event or once a year festival, you might consider renting out your house for those weeks surrounding graduation or this major event, get the quick cash and, stop renting it at that point. But yeah, it's kind of a nice little quick cash in your pocket.
Yeah. And it's tax-free. That's the
exact. Well, that's the key.
Yeah. I think I had read about this. Is references the Augusta rules in Augusta National, the golf course in Georgia, where they play the Masters every year. People that live close to there rent their house out for a week or two.
Exactly.
And they get a considerable amount of money and it's tax-free. And maybe you pay for yourself to go on a vacation at the same time and you still wind up with the money left over.
Yep, exactly.
And I thought about, too, another odd application, but now with these companies like Airbnb or VRBO, it makes it even easier to do this because before maybe you had to find a friend or somebody that was interested. Now it's really easy to put this out there to take advantage of this strategy if you want to.
Yeah, no, absolutely. That's a good point. You post your house, you can take it down, immediately after it's rented out. Yeah, it is a great tool to help you out. Of course, you got to pay the fees, but it might end up being worth it depending on what you're renting for.
Yeah, it's a little extra income in retirement, maybe. And tip number 5 you had mentioned was kind of possibly for people that are set up as LLC or SCorp, maybe moving to an SCorp, right? Or looking at that.
Yeah. So a lot of, new clients or clients starting up small businesses, they start with the simple form of business. They might create an LLC. single member and they're acting as a sole proprietor, one thing I talk about right away is that this concept of self-employment tax. So they're self-employed and they don't typically realize that they're basically acting as the employer and employee, meaning they have to pay in the employer and employee portion of Social Security and Medicare, which is roughly 15%. And that's on top of your income tax. So if you're in the 22% federal tax bracket, 5% Connecticut, you're looking at paying over 40% in taxes. So it's not often realized by new business owners. So that's definitely a reason that they might want to look at the opportunities of converting or making the election to be an SCorp. If they do make the move over to the SCorp, is they have to take something called a reasonable compensation. So now they would be on payroll and avoid this self-employment tax. But reasonable compensation is key here because that's another thing that the IRS is big with scrutinizing your reasonable compensation. So for instance, I'm going to take a reasonable compensation of $1 for doing the job I'm doing. Yep.
Okay.
Any of the profit.
You're worth more than $1, Laura. I know that.
Yeah, there you go. So what these people do is you avoid the self-employment tax on the profit above that $1. So if your profit on the company is $200,000, you're going to get paid $1 as a W-2 employee, and then the other $100,000, $199,000 is not subject to self-employment tax. Obviously, that's a red flag to the IRS, and they're going to say, no. You need to take a reasonable compensation. So now they're paying payroll taxes for the reasonable compensation, and above and beyond that profit, now you do not need to pay self-employment tax. So the reasonable compensation might be $100,000 for doing that job, whatever the job may be. So now you are paying payroll taxes. You are paying, essentially you're the employee and employer. So essentially you are paying that 15%. But on that additional profit, the additional $100,000, you're not subject to self-employment tax. Does that make sense?
Yeah. So let's take a step back. So you're filing as an LLC right now. You make $200,000 from your business.
Yep.
The IRS has a limit on Social Security tax up to, what is it, like 140 something thousand?
I'm just going to say it's around 137.
All right. So you only pay Social Security up to that let's just say 140,000. I know it's a little more.
Yeah.
Anything above that, that's 60,000. You don't pay the Social Security tax.
Right.
But what you're saying is that instead you could decide to move to an SCorp. Maybe the reasonable compensation for you is only 80,000, let's say, right? Yep. So now you're saving $60,000 that you normally be paying 15% tax on that Social Security. Now you avoid that.
Absolutely. Yep.
Okay.
And that's big. And that's why it's so scrutinized, because somebody can say, okay, I'm going to pay myself $1 and then the profit is not subject. So you see why it's got to
be reasonable.
Absolutely.
Yeah. Yep. Where does someone go to find what's reasonable compensation? How's that determined?
It is always the topic of discussion. In fact, when we have our CPE credits and things, it always comes up. What is reasonable compensation? So it really is, what would you be paying an employee for doing the same job? Would it be $10 an hour or would it be $100 an hour? So, you kind of have to have your reasoning. So if the IRS ever came to you and said, what is this? Okay, well, this is payment based off of what I would be paying my employee at X amount. So you just have to kind of have your backup ready.
Sure. So maybe the internet could be helpful to look to see
Absolutely.
There's all kinds of studies out there about what reasonable or pay ranges are for jobs. So you go find that. Maybe you take the middle range or whatever you decide, right? And based on where you are too, right? If we're in a high cost of living area, but maybe if you're in a lower cost of living area, you could pay on the low end of that.
Yep. Absolutely. You might look at average salaries. If you're, a plumber, average salary of plumber in Connecticut. And that's definitely a way to start that conversation.
Okay. Are there any downfalls if you do make that decision to convert over to the SCorp?
So, one of the things is your profits. So if your profits fluctuate, it's kind of hard to predict what that consistent, reasonable salary is. So, so you want to ensure you have that cash flow in order to meet that reasonable salary year to year, because you can't not you have to take a salary. So if you're doing horribly one year, you can't just not pay yourself.
You got to keep paying.
Yeah.
So it sounds like you have to set up a payroll company or do your own payroll where you're getting paid every 2 weeks or every week.
Yep. Just as if you were an employee, you got hired somewhere else and you're going to expect your paycheck if you're working. So, so that's one of the things. You just want to make sure your cash flow is consistent. One big thing is you're not eligible for the home office deduction because now you're treated as an employee. Earlier, I mentioned, if you're working from home now because of COVID and you're using your own, your desk at home, your own utilities, and you're an employee, you can't take that deduction.
Yeah.
So same goes with the SCorp. So if you're an SCorp, you cannot take the home office deduction.
Okay.
So that's a negative.
But all the same deductions that would apply to the business as far as business expenses would still be there.
Yeah,
right?
other than the home office.
Other than the home office, yeah.
But the car, your mileage, you also cannot take, because again, you're an employee and employees cannot take mileage as well. So in the past they could have. Now a lot of companies, what they do is they'll build it into their salary somehow, or get reimbursed. But yeah, you cannot take home office or mileage.
Oh, okay. Interesting. So if you were going to do this, I'd read something that you wouldn't want to start as a sole proprietor, because you can't move from a sole proprietor to like a S-Corp, or can you?
Oh, you can. You just need to make the election with it's called the Form 2553. I think it's the 15th. I think it's March 15th. It's March 15th that you have to make the election by in order to qualify as an S-Corp. There might end up being tax consequences if there's assets involved that need to get converted. But no, you can definitely make that election. Okay.
Can you go back and forth? Can you decide one year I want to be an S-Corp, one year I don't?
Yeah. I mean, that'll definitely get complicated. I think you certainly can. Paper trails might be a little bit difficult to do. I wouldn't recommend it. I think, once you make the move, you stay in that. There's obviously reasons that you made the move. So I would try to talk with a client and figure out why they would want to move back.
Sure. What about for the maximum on retirement plans? Let's say you're trying to max out your profit sharing plan. Mm-hmm. It sounds like if you did this, you could still do the max 401k plan, the 26 or it's now 27,000. But let's say you were trying to do a profit sharing component too. I guess that would be limited by whatever your salary was, right?
Yeah, it's the salary. Truthfully, I don't know the specifics, Ryan, as what would constitute that. But yeah, it's definitely salary based. And again, if you're an S-Corp, you have to be taking that salary. So that's where some of that prediction comes in. If you say my salary is going to be $100,000 and that's what it's going to be, hopefully you can plan accordingly. And so you're not fluctuating year to year.
Yeah, that'd be a trade-off to look at.
Yep, absolutely.
Okay, awesome. I think this is a good point to wrap up. Is there anything else you want to mention today?
No, I mean, I think just with businesses, I'll say it again, with tax planning, definitely critical with businesses to actually do your tax planning. Usually what we do is right after tax season, so around April, and then so we do kind of like a mid-year plan, and then towards the end of the year. You should do it every year, especially having a business, but especially if you're have any major changes, or you want to add a retirement plan, or you want to add this HSA, or you're adding employees, whatever it might be. Just again, I'll hit on tax planning is critical to be successful.
Definitely. Yeah. The better you plan, usually the better things work out, right?
Exactly. Yeah. Exactly.
All right. And again, just if people want to get in contact with you to get help with their own taxes, how can they do that?
Yeah, absolutely. So they can give me a call at my office, 203-248-8600, or my email is laura@ccotax.com. And you can email me, call me anytime.
Okay, wonderful. Thanks for coming on again, Laura, and look forward to having you back in the future to talk some more taxes.
Thank you, Ryan. Thanks for having me.
Thanks for tuning in this week, and look forward to talking to you next Wednesday.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.